We have seen immense volatility in the precious metal space. Yellow metal coming under pressure on news that we could see quantitative easing coming to an end, and that inflation will feed through into the US economy, and thus we could see a rate hike in the US. How possible or how capable is the scenario of playing out going forward, or do you think this is just pure speculation?
I think it's pure speculation. We as a bank don't see the Fed moving to raise rates much before second half of 2012, but some tightening of monetary policy could be implicated by the end of their bond buying program, which is scheduled for June of this year. The so-called QE2, quantitative easing phase 2, will come to an end in June. There had been speculation which was bullish for gold that QE3 would soon follow on the heels of QE2, but that's looking unlikely now as the US economy appears to be in better shape compared to, say, 6 months ago.
In terms of long positions, when it comes to gold, we saw that increasing around 3% in the week to March the 22nd. On the silver front, longs also gained around 4%. I'm sure the scenario has changed quite extensively. Tell us about the play between the likes of the long and the short positions going forward, because some are still relatively pessimistic in terms of what we will see in the US. Inflation is still that nagging worry for a lot of investors out there.
We believe that inflation's probably only one of the factors that is leading investors to be very uncertain about the future. You've got a lot of geopolitical risks. Libya and the whole region seems to be very unstable. Inflationary risk because of the elevated oil price, and you've also got concerns about sovereign debt, particularly in the Eurozone, but elsewhere as well, potentially Japan, as it has to try to find ways to fund reconstruction after the earthquake, tsunami. So there's, we think, a lot of underpinning to the gold market, and initiating fresh longs below 1400 we believe would be a good strategy to adopt. Also for silver, any fall below a floor around 35, 36, worth initiating long positions in silver, because silver, we believe, will track gold both up and down.
Well, it's quite interesting when you mentioned the silver market. I mean, we saw margin hikes coming to the fore by the CME, and that should have quite a significant impact on the silver market, they say. Or do you think that it might be an opportunity for some who want that entry point and that realize that perhaps the move by the CME actually signals a silver price closer to $50 or even $60 an ounce?
There is a strong likelihood that, you know, silver in many ways is almost seen as a win-win metal. It would do well if the uncertainties persist. If global growth is for whatever reason derailed, then precious metals like gold will benefit, silver will benefit on the back of that. However, it's an industrial metal, so if the global economy strengthens, the recovery deepens, then there'll be increased industrial demand for silver. So that's why I think investors will look at any dips, whether it's because of margin increases, whether it's because of China tightening monetary policy. They will look at those opportunities, as you've mentioned, as entry levels back into the market.
Rebels in Libya running oil fields and talking about 100,000 to 130,000 barrels per day, just keeping in mind that Libya was pumping around 1.6 million barrels per day before the rebellion, and we know a very willing buyer from these rebels is Qatar. We've got an oil price, Brent crude price, sitting at around $116 a barrel. Where do you see oil going from here if we start seeing the supply constraints that we saw previously start abating, and that Libya is starting to produce at least some of its production?
I think on the basis of easing geopolitical concerns, less contagion, spreading within the region, and the ability of the rebels to pump more oil, that should perhaps see the oil price moving back towards the $100 per barrel level for Brent. Clearly, as you mentioned, Libya was producing before the unrest 1.6 million barrels per day. So even at 100, 200,000 barrels a day, it will still be far short of what's needed. So again, perhaps we would look for a floor around the $95, $100 per barrel level going forward.